Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard, and yes, we're here with our plain-spoken truth and our hard-hitting style.
I want to complain for 1 second.
All right.
About getting old.
1 second?
Since I had my colonoscopy last week.
Oh, there it is.
That was a great time. I went to my hairdresser this week, cutting my hair, and I go, yeah, when I was younger, I had some, really thick hair. They said they couldn't hardly put it in their hand. And she goes, not anymore. And I go, oh, really? Maybe I need to change hairdressers and realize that I do have Fabio hair.
That's like when you tell a self-deprecating joke and everyone laughs a little too hard. It's like, don't laugh so hard.
Yeah. So everybody tells you that, you get wiser and you get everything. I can't think of one thing about getting older that makes me smile. Not one thing. I'm tired.
I was walking through the living room, I don't know, years ago, 5, 6, 7, 8 years ago, and my wife had on Oprah Winfrey. Let's be clear, I was not sitting down watching an Oprah Winfrey show.
Sure you weren't.
And I paused because Raquel Welch was on there, and I think she's like late 70s now, and looks awesome, like she's 35. And Oprah, as I was walking by, just at that moment, asked her, she goes, I gotta ask. She goes, do you feel as good as you look? And she's, oh, hell no, this hurts and that hurts and I can't get up.
Finally an honest answer.
Yeah.
I'll sleep on my shoulder wrong. I'm like, I shouldn't have slept that long. I got to flip over 15 times a night. Oh, I can't think of one thing. They always say, oh, no, you're wiser, you're calmer. All of that's out the window. So that's my gripe, and I won't do it anymore.
What's the old saying? Too soon old, too late smart?
Yeah. I can't think of. They say, if I knew now what I did. I didn't have any energy.
I got to tell you, though, quite frankly, when I was in my 20s, I knew it all. And I'd tell you so.
Oh, yeah. I thought my dad was, he's a complete moron.
What did he know? That's right.
When you get older, you're like, hey, they knew a lot more than you thought.
Oh, I know.
Oh, my kids all the time. One's 32, then I got 16 and 10 and 11. Well, Dad, you just don't understand nowadays. And I'm like, really? I don't understand it? Really? Oh, yeah, math is much harder than it used to be. Do you realize that?
Oh, well.
English, all that stuff is much harder than it used to be.
I do believe math is harder than it used to be because they got all sorts of quantum math now that they
I remember doing
even around then.
Engineering with a slide rule, and that wasn't that easy. These computers and everything else.
Remember when they came out with calculators and everyone thought that was cheating?
My dad had a calculator. It was a TI, the first one.
That's right.
The red light, red stuff.
Yeah.
It added and subtracted. Oh, it didn't divide. It didn't multiply. But it was $700, and we thought this was the coolest thing.
That's about the time digital watches came out. And they remember the black face? You had to hit a button and it'd light up in red, and it was red. Bringing it back to investments, just think how much your investment philosophy has changed and what we've learned. I remember when I started out, we kind of started out together, and we would hitch our wagons to the number one money manager, was Peter On at the time for Managed Futures, the number 7 ranked stock manager by Nielsen's, and they did great. Until the market showed them something it didn't do before, and it completely changed.
It's a bad word now. The way you start out as stockbrokers.
That's right.
Now nobody called himself a financial advisor, a financial planner. You were proud to be a stockbroker.
Let me tell you what's going to happen.
I got this great stock. They cured AIDS. They did this.
Oh, I know the potential.
After all those great stock tips, half of them not working out. I'm like, I don't think I'm a stockbroker. I think I need to do something else.
Well, when you're young, you lose your money. You lose some of the clients' money. Not intentionally. You've got the best intentions. You got the number one money manager, but it still doesn't happen. And then, of course, you lose clients. Think about it. We used to tell everybody, and it's true, all the guys listening now and gals, Money Magazine has the 10 must-own mutual funds. You go back 5 years, you can get that copy. 10 every year, really, but 10 years, 15, 20, 25, 30 years back. Get a copy of those. I assure you, none of those are must-own mutual funds today.
They said if you buy the top 10% of mutual funds, you'll own the bottom 10% within 5 years.
I know. But that's wisdom. You don't believe that until you've lived it, right?
Well, I've invested in stocks for decades. I've managed stock portfolios for decades. And the one thing that cured me of the individual stocks, one thing, was a company called Colonial Data Technologies. They called me and said, Victor, we've got the greatest thing in the world. When somebody picks up the phone, you're going to know who's calling before you answer it. I go, what? It'll say their name and their phone number. And I go, get out of here. All of the Bell companies at the time, I think they weren't AT&T, they were Baby Bells or whatever. They had to pay them a patent fee. So I go, wait a minute. So this company, all of these phone companies in America are paying them a fee to use this technology. It'll tell you who's on the phone before you pick it up. Wow. That's got to be a winner. That company was called Colonial Data Technologies. They invented caller ID. And what happened within about a year or two?
China stole the technology? I'm just guessing.
Actually, AT&T and Bell stole it.
Yeah,
They figured out a way around this patent.
Yeah.
And now caller ID is it. But that's because if you put yourself back, think about it. Put yourself back before caller ID. You had to pick up that phone as a telemarketer or whatever.
You didn't know if there was an emergency.
Right. You had to pick it. So that did change the world, but the company that invented it all went out of business.
And now we're not saying that there's individual stocks are wrong. I've got a client, will go nameless, that he wants to invest in some marijuana stocks. He keeps asking me for articles. He thinks it's going to be like alcohol. It's going to be the next billionaire thing. And, I told him, if you want to risk 5 or 10 grand, depending on the percentage, and, you want to get the penny stock version, do you want to get the Canadian version that's been around the longest? I mean, there's nothing wrong with that, but, you don't base everything
I just
on
don't
those
know.
sort of stocks.
I know there's something behind me that says marijuana stocks. Now, I've got relatives that partake in marijuana. And they're not the most motivated people I've ever met. So are the different ones running the companies? I don't know. I could be totally wrong. I don't know.
I agree with you, but I tell you what, you want to get going down that rabbit hole a little bit. When they talk about gateway drugs, to me, you know what the gateway drug is?
I don't know.
Alcohol.
Oh. I've done some stupid stuff on alcohol when I was young. Now I'm too old and tired.
No,
I think it's a good idea. Let's do another shot when I can't stand up. Yeah, that sounds like a great idea. All right, well, that's enough of our BS. The Fed raised interest rates a quarter point, or another way to say a quarter point is 25 basis points.
Now, didn't we just get through spending 5 or 10 minutes talking about getting wisdom over the years?
Mm-hmm.
Why does that not apply to the Fed? Oh, because we keep getting new chairmans, and they have to go through the learning curve again. Bernanke, Yellen, and now the new guy's going through the curve again.
Supposedly
on our money.
I wrote down about 15 or 20 things they actually go through to whether, all right, does it make sense? Does it make logical sense to change interest rates? I had no idea. There's 1,600 things, supposedly, that they go through to get that. Now, they obviously know more than you or I or anybody.
No, I'm going to say no to that. I'm going to say obviously not.
They have, 8-year terms?
Where have you been the last 90 days? Have you not watched what they're doing?
So on Wednesday, when they announced it at 1 o'clock, the market was up, 300 points? Then it was down 500.
Yeah.
I can't even remember where it closed at.
I don't remember either.
I didn't even look. But it turned around a lot. Now, why does interest...
And you would have thought that was figured in already.
Oh, yeah. They said it was an 80-something% chance they were going to raise rates.
They went on to say, if you recall, and this is what they got hammered on by all the talking heads, and everyone's got their own opinion, they didn't lighten up or soften up their projections for 19 as far as continuing to raise it. Right. And they all said they should have at least softened their position, that they're closer to neutral.
Right. The one thing they're trying to do with raising rates is they're trying to slow down inflation. A couple things happen when you get people are all employed.
Problem is there isn't inflation.
Right. But there's, like I got right now, inflation was 2%, 2.3 at the peak, which was July.
You know what I think they're trying to do?
So it's come down some.
I think they're trying to give themselves some cushion so that they can lower rates later when they need to.
And they'll do that too. Core inflation was 2 Now it's down to 1.8. Unemployment rate's the same, 3.7. Inflation expectations were 2.4 when it was expected at 3.2, the high. There's a whole bunch of, there's 40, 50 new home sales, 544,000. It was 712,000 in November of 2017. That's kind of like December 2017 is kind of the peak. If you saw it, remember the market made 20-something% that year. And that's what we got to tell people. A lot of people are starting to get nervous, freak out. Well, after the break, we're going to tell you what you need to do with this market volatility. Don't hesitate to call us if you have any questions. 972-715-2424. Call us at 972-715-2424. We got a break coming up, folks. Stay with us. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. What we're talking about, the Fed hit us with a quarter point rate. What is that, 5 times this year? Can't even remember how many times it is. But it's gone up quite a bit. If you're looking at home mortgage loans, those are all affected. Car loans.
You never would, before you weren't really thinking too much about interest rates because they were low. Now, any of these decisions that you're making, your home, your cars, or whatever the case may be, you got to think a little extra harder. And, just because the Fed rate is going up, it's not all panic selling and people in a recession and scary sky falling stuff. Think about it. Although the bond curve is pretty much flat right now. But in theory, as rates go up, you're going to get some decent rates the further out you go in bonds. And what does that do to your stock money? It makes you think twice as you would about buying a house because of higher interest rates. It also makes you think twice about whether do I want to risk my money for a 5% return in the S&P, or do I want to take a solid 3.5 or 4% without any risk? So it's providing competition to those dollars as well.
A lot of people don't really understand inflation because it doesn't really hit home. If a pear goes up a penny, you don't even notice it, right? Well, you can see inflation in action, just like in housing prices. When you look at housing prices, as soon as those, when the inventories are low and everybody's trying to buy, housing prices keep going up, and they get it to a point where they might not be sustainable because the job force is making a certain amount of income, and these houses are priced up, just like California has a really low percentage of people that own homes. And so that's what you've got. So you can see it in home prices. And remember, we talked about it on this show, had the largest inventory in homes in Dallas since 2007. All of those things indicate one thing. If you got 100% of your money in real estate, be careful.
In anything.
Be careful.
But absolutely.
But what I'll tell people are, if you stick with the rules, in other words, whatever your age is, keep that much safe. You can vary off of that, 10, 15% or whatever. But if you keep that, because what has happened in the last couple of years, since the election, the market is still up 20 or 30%. Who cares about what it is? Because who cares about what it is now? Here's what I find a lot. Guy, you could back me up on this. When the market goes down, like it's all, 15% off the high or something? They said, well, I need to do something, but it's too late now. I need it to go back and get even. If you're waiting for that, you have to ask yourself, can you live with the consequences if it drops another 30%? Because that's what it can do. It's done it twice this century.
Well, and also, we talked about it earlier in the week. In fact, you brought it up. Forget that part of it. What's important, you don't want it to go down another 30%. Right. But people, the one place they're happy with selling their stocks is what they paid for it. If I paid $10 and it's $10, I'll sell it for $10. Why? Because if it's 15, you're not going to sell it because it's going up and you don't want to get out of a winner.
That's right.
If it's 5, which may be the case now, you're not going to sell it because it's losing. I won't be happy till it gets to 10. Here's a better way to look at it. Since the election, your accounts, unless you've been paying too much in fees, which we can help you reduce or eliminate, I'm just saying, is probably up 20 to 25% from where it was since the election. Yes, it was higher 90, 120 days ago, but you're still up substantially. We talk about it all the time. De-risk your portfolio To what point? To the point of your age. Whatever your age is, Victor just mentioned it, that's how much should be de-risked. There are some ways to de-risk the portfolio. You've probably seen other folks' commercials where you can still participate in the stock market growth. Get somewhere between 4 to 7% without taking down years. When the market goes up, you get to participate in the profits. When it goes down, you don't make anything, but you don't lose anything. And in the market, you actually go backwards. There's some neat things and tricks. Over the years, we've learned. We've been doing these things since 95, and we can help you with that.
Just remember, de-risking a portfolio, sometimes it's not that you didn't start out 5 years ago having too much as stocks. Remember, I like stocks. I'm invested in stocks right now.
Have clients
I'm always going to invest in stocks.
That's right.
I've got clients invested in stocks. But how it happens is if CDs, your safe money was making 1, 2, 3%, and your stocks are making 15 or 20, you got to, even though your allocation was perfect, it was a 50-50 allocation 5 years ago. It's probably 70, 30, 80, 20 right now. If you had to rebalance that entire time each year, you'd be fine right now. This downturn doesn't affect you nearly as much. But what happens is, and we call it analysis paralysis, just like Guy said. When something's going up, there's something that innately says, oh, I can't sell that, it's going up.
That's right.
So if something's made 20%, you want to get me out of that.
That'd be
and
stupid.
Put something making 2.
That's
Are
right.
you kidding? Or if it's going down, well, I got to wait for it to come back up. Last time the market went down like this, it took, depending on if you're NASDAQ or S&P, 5 to 7 years to get your money back. If you're 25 years old, no big deal. Wait it out. What if you're 60 and about to retire? 65, 70, about to retire or retired?
And drawing off the account.
And you're drawing, even worse. If you're taking money out and it's dropping, remember the sequence of returns risk is real. The 4% rule, taking out 4% of your assets, has not worked this century. If this market holds, like down, say, 5%, it's going so much every day, but let's say it ends up down 5% for the year. For the last 19 years, the return would be under 4.5% a year. Now, think about that for a second. Remember that the stock market makes 10% a year. It's made 4.5%. It took almost 10 years, 1 month shy of 10 years up in a row to get me to 4.5%. It was less before that.
That's right.
But let's talk more about it after the break. Remember, if you have any financial questions, I'd like to take advantage of our no-cost, no-obligation portfolio review, showing you how to de-risk your portfolio, retirement plan, stress test, or Social Security Optimizer. Don't hesitate to call us at 972-715-2424. Again, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. As a repeat, the Fed raised interest rates much to President Trump's chagrin. They raised interest rates a quarter point.
And to the stock market, there's a whole lot of people that will credit this correction, if you want to use that term, to the Fed's inexperience, the new chairman's inexperience. Yellen went through that. Bernanke went through that. And they use a lot of things. We started out in the first segment with a whole list of different criteria and charts and statistics that they use. One of the complaints I've heard is that they're still using what's referred to as the Phillips curve, and you can certainly Google it. A.W. Phillips is who it's named after. And basically, without getting into the weeds in it, is he talks about inflation and unemployment having a stable and inverse relationship. The problem with the Phillips curve, as you'll read if you do Investopedia or do some research on it, is due to the occurrence of stagflation in the 1970s, the theory was somewhat disproven. But they're still using it. And I think it's like anything we talked about when you first started out being a stockbroker or an advisor. You've got a learning curve. Well, these chairmen, even with all of their experience and all of their knowledge, and they certainly are smart, they've got a learning curve, right? They try something and they adjust it. So
my kids laughing at me for reading the newspaper every day. You know that's on the internet, don't you? No,
yeah, you don't need
I did not know that.
You actually use paper?
Yeah, what are you doing that for? That's big, bulky. Here, it's on your iPad. Yeah, okay. Well, remember, de-risking your portfolio when the volatility like that is very smart. It is something that everybody should consider doing. Now, you got to ask yourself all the time. Remember, we love stocks. We have a great managed program at Fidelity. Just saying. All right, we got all that.
Yep.
But you got to always remember what the reason is why you invest in stocks. There's only one reason. There's nothing else in the world. There's one reason. You got to boil it down to you invest in stocks because you want more potential gain than a CD. You're willing to take the risk to make more potential than a CD. Otherwise, you'd have all your money in CDs, right?
Yep.
Have it all in CDs if you're okay with you want more potential. So, if that's the case, if that's what's holding people back or making you pause to de-risk your portfolio at least down to the levels it should be, there are ways, like Guy said a couple segments ago, that you can do this. Remember, market, if it stays where it's at, I don't know what it's going to end up the next 2 weeks, but if it stays where it's at, you're talking about a 4.5% return over the last 19 years. This century, I've got still people doing retirement plans based on 7 to 10% a year.
We see them all the time.
Every day. Now, how could you do something 7 to 10% assume returns? You're ignoring this century. You're ignoring the last 19 years where it's only made 4. So think about it. You're willing to take the risk, which I'm willing to take the risk as well. I'm in the stock market, right? I'm in the real estate market. I've got rental home, whatever. But you're willing to take the risk. Well, what if you didn't have to take the risk? You could de-risk your portfolio. You could get your income bucket in place, the most important part of your buckets. Remember, you got the cash bucket for emergencies, reserves. You got the income bucket. Then you got the growth bucket. The most important one is the income bucket. You live on that for 30, 40 years.
That's the secret sauce is the income bucket.
So you get the income bucket. You de-risk your portfolio. You get all your valuations where they should be. But what if you could get something, the worst it's ever done is 4% a year? Now, remember, we just said the market went down 50% twice, and it averaged 4.5 if the market holds for this century. What if you could get 4 to 8, 4 to 7? I got one that's 6 to 8. What if you could get that instead of? So the only reason you invest in stocks is potential to make more in a CD.
Absolutely.
Well, you get that potential to make more in a CD. Historically, way better. And you don't have to risk the money, and you get the income bucket.
But I wish I had all my money in Yahoo when it first came out.
Oh, yeah.
I'd be a millionaire. We've gone through the fancy terms and tried to explain the chart on the radio, but we'll just boil it down to real simple logic. Look at how much you have to risk versus your average rate of return. So let's talk about the stock market. If it can go down, and I'll be kind, 30%, I won't say 50, or you can have a 25% up year. That's your risk. So you can go up 25 or down 30 to get an average 5, or you can get something that fluctuates from 4 to 7%, like Victor said. The worst it's going to do is 4. The best it could do is 7. What makes the most sense?
Now, there's other things like bonds. If I could get interest rates on bonds, like a 10-year bond making 6, 7, 8%, I'm talking about good stuff, AAA bonds, not high-yield junk bonds. But if you can get that, bonds come into play. Right now, they haven't come into play in a long time because right now 10-year yields are under 3.
And when they were 14% long bonds, no one wanted them.
That's right. So that's what you got to ask yourself. We'll talk more about it after the break. But remember, if you have any financial questions, like to take advantage of any of our services, don't hesitate to call our hotline at 972-715-2424. You can always go to our website, ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
The market is very volatile. Fed's raising rates. There's uncertainty, geopolitical uncertainty all over the world.
700-point swings.
In a day.
France literally is on fire. Right. Britain's trying to decide whether they want to re-vote on Brexit, which apparently that's not going to happen now, but they're going to put something up for vote, which obviously is going to fail from what you hear. I hear in France now there's signs coming out, and I forget the hyphenated word, but it's Frexit or something.
Yeah. France exit.
Yeah, the France exit. Germany is getting sick and tired of support the citizens, of paying for the debts for Spain and for Italy. I mean, that thing is really fracturing. Do you think that'll have an effect on our market? Absolutely.
It's weird. Every time I see a protest, I think because I'm an old school kind of person. My son, who's the professor in New York, he says, well, they're exercising their democracy and they're trying to affect change.
Absolutely.
Me, I go, it's Tuesday afternoon. Why ain't anybody at work? Is that wrong?
That's right.
Am I wrong? Please, if you're really liberal, don't call me and yell at me.
Along that line, I saw actually it was on Facebook, and I was doing some stuff for work because I don't hang out there. But this guy had a picture of a brand new Corvette on there, and the caption was, someone walked by me the other day and told me, said, do you know how many poor people or vets that the money you spend on that Corvette could feed? And he said, well, I really didn't realize about that. He goes, I got to think about all the manufacturing jobs that got paid for making that car, the paint companies that got paid for the cars, the parts that got paid for the car, the salesman that sold the car. He goes, no, I really don't know, but I bet it's fed a lot. So, it just goes to show what your point of view is.
That's right. The de-risk a portfolio.
If you're willing to work.
That's right. We don't ever tell anybody on this show to do something. I'm just telling you it's a really good idea now. It doesn't matter. It's gone down from the high. You're still locking in 20, 30% gains since the election. Consider yourself lucky. Move away. You got to de-risk into normal levels, okay? If you do that, if you need help with it, or you got somebody, I'm afraid to, what should be the best way? Because remember, we can help you de-risk a portfolio, guarantee your lifestyle, get your income bucket in order, and not sacrifice returns. Call us at 972-715-2424. Again, 972-715-2424. You can always go to ilovemyretirement.com.
And I'll add real quickly, if you've got a great 401k and you're at work, and if you're 59 and a half, you have to be 59 and a half to avoid penalty. You can do what's called an in-service withdrawal. Why would you want to do that? You're still continuing your 401k, you're still contributing, the company is still matching it, but usually within the limited options that you have, and they're usually expensive too, not all of them, but they're usually paying a pretty good amount in fees that you may not be aware of, but you have limited options and you're captive. You can take an in-service withdrawal. It doesn't affect anything, but what you can do is now it becomes an IRA. It doesn't trigger a taxable event, and it gives you a lot of options. You want to defer some for income and get it guaranteed and get between 4 and 7%, you can do that. If you just want to go to Vanguard, you can do that. It makes a lot of sense.
You've got 10 choices inside your 401k, 100,000 choices outside. If you like any of the choices in the 401k, well, you can buy them in the outside. But you'll have all the rest of it. You can do whatever
usually
you want.
For less.
That's right. So anytime anyone turns 59 and a half, doesn't matter if you're going to work till you drop, work for 10 more years or 2 more years. You need to consider an in-service rollover, because once you've attained that age, the Supreme Court ruled that you can sue your employer, so all of them back 15 years ago said, nope, let them out at 59 and a half, even though they're going to stay here. One key thing, don't take all the money out, because you want to make sure they don't think you're closing out your 401k.
Absolutely not.
So, if you got $1 million in there, leave 20 grand in there, whatever, just so they know you'll still get your matches, still get your contributions. On that vein, 2019, they're raising all of your retirement plan limits.
Yay!
I mean, not a whole lot, but
but they're inching up.
Okay, 19,000 will be your 401k. So everyone, if you are maxing out your 401k, all of your engineers, which I know all of you engineers do it.
You probably already know about it.
That's right.
That's right.
But it's going up. So go to your HR, get the form, add some more to it, because it's gone up $500. $40 a month or whatever that you can add. 19,000. You still got the 6,000 if you're 50 and older. So that's a total of 25,000 plus any matches from the company. Okay? Your IRA has moved from $5,500 to $6,000. $6,000, and the 1,000 is still there for over 50. So you can put in a total of 7,000.
Catch up.
If you're over 50. People always ask me, why should you should always max out a 401k. If you hear one advisor, I'm going to call them so-called advisor because they're not, telling you, no, you should do this instead of, well, this is going to beat the pants off your 401k. that is someone not an advisor. That's somebody trying to sell you something. Because that is the dumbest thing I've ever heard.
The buckets are in order. Liquidity, take care of that for emergencies. And then the income bucket, which is where your 401k is, max that out.
Also, your 403bs, 457. 403bs are typically teachers, things like that. 457s can be government plans, something like that. But those are all going up to the 19,000 plus the 6,000 catch-up. All right. Also, the income phase out for Roth IRAs is going up. In other words, it's for singles. If you make between 122 and 137, or anything over 137, they're phasing out. You cannot do a Roth. For married people, it's 193. It starts phasing out to completely phase out at 203, and that's up like $4,000 from last year. So if you're making it, everybody asks me, should I do a Roth and the other? Well, if you're in the income rate, sure. If you should do a Roth or a regular, most of the time, a regular IRA, regular 401k will outdo a Roth because you're in a lower tax bracket in retirement versus a higher one while you're working. It's not always the case. Now, there are exceptions to that. Remember, if you have a bunch of tax write-offs, farm losses, anything like that, then you can start converting stuff because you can write it off. And we can help. We do that stuff all the time. Call us at 972-715-2424. We got a break. Stay with us. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. Guy and I were just talking about before the break for shoes. We're talking about shoes. And it's my wife's is from, I'll just let you know, Gun Barrel City, Texas. And that's out in East Texas, Cedar Creek Lake. And she goes, what kind of man are you that you love shoes, that you research shoes? I go, but I hunt and fish. I got guns. He goes, what the heck's going on here? I'm like, it just made me think. I'm like, what's wrong with shoes? You're like Imelda Marcos over there. I'm like, oh, whatever.
Hey, you were mentioning if you qualify for a Roth, and what I mean by that is if your income is such that you're going to be in the highest tax bracket in retirement, right? So you're going to pay as much in taxes on your required minimum distributions on your retirement accounts as you are now currently when you're living. That, to me, is an automatic. You would qualify for one. There are some things you're limited, certainly, by income as to what you can deposit in one of those, which is what Victor just went through in the last segment. But there's something that's referred to as a backdoor Roth IRA, and they haven't closed the loophole. Obviously, you can contribute to the 401 and do all of those things, and then you can convert that money into a Roth, which gives you a much larger amount that you can contribute if you're wanting to get more into the Roth, if you're in the highest tax bracket, if it makes sense. Like Victor and I always try to do with our clients is give people their options, take a look at the situation. Obviously, you make the decision.
It's a weird thing with Roth. I like the idea of it and everything, but it is a weird thing how everybody thinks the government gave us such a gift.
Oh, yeah, tax-free.
That's right. The Roth thing was the government takes like 30 years to get your tax money off a typical retirement account. They figured out a way to get all of that right now, all up front. So think about the time value of money, how much extra that is for the U.S. government.
That's right.
They did that first. And then they had limits. Well, if you make more than $100,000, you can never convert a Roth. And then they go, why are we being stupid? Let's get rid of the income limitation. Just let everybody convert a Roth. We're going to get 30 years worth of taxes now.
When they first came up with the idea, right, in the mid-'90s, remember they gave them 5 years. You can convert it all now and pay the taxes over 5 years.
But you think about that. All of those taxes that would have taken. Now, remember also, when you take out big IRA conversions, right?
Right.
You're getting 40% tax, 37, whatever, right?
Yep, that's right.
You're like, there's no way they're going to be 37% tax when they're retired. So this was a government, it was like a windfall. And so every time I help people say, oh, my gosh, it's the greatest thing in the world, I'm like, really? It was a great thing for the government.
I talked to a guy earlier this week, won't mention the name, because if he's listening, he'll know who he is, certainly, but I would never share the name. But it's one of the largest IRAs or 401ks retirements that I'm familiar with. He had about $4 million in the deal. You think about that. Your required minimum distribution at
A little under 4%.
Age 70 is a little under 4%, so we'll call it 4%. That's $160,000 that you have to take out. So depending
on top of your Social Security
and everything else, so that person would qualify.
That's right. Remember, some things Roth is, if you're always going to be in the highest tax bracket, a Roth makes sense, especially after tax cuts, because you're protecting yourself against future tax increases. But for some people, it makes zero sense. And most of the people that do it don't make sense. Let's say you've got a lot of farm losses, you got a ranch. Oh my gosh, I've got so many clients that have basically converted out of taxable IRA accounts and put it in other ones. Because I've just never had an accountant that could actually figure out losses for me, that I could depreciation stuff. All I do is write a ding check every year. Oh, you only have to write this much this year. Oh, thank you. Oh, really?
Yes, you're in the alternative minimum tax this year again. Oh, joy.
Thank you. If you weren't in that, you would have actually got money back. Oh, really? But write me a check for another $100,000. Okay. Now, my dad calls that a high-class problem.
It is a high-class problem.
But it's not high-class when you got to write that check. Remember, everybody tells me I don't pay my fair share in taxes. Usually don't pay any federal taxes. That makes me mad.
Yeah, someone complains about paying too much in taxes. I'm usually happy because they're doing pretty well.
Okay.
Keep in mind, the Fed, like the stock market, and obviously they're linked right now. If you're allocated properly, you shouldn't be losing any sleep. You should be happy with the way things are going. Don't stress. Just be prepared.
Also remember, this century, since the market only averaged, if the market holds from what it's down, I don't know what's going to do the next 2 weeks, but if it holds, it's only made 4.5% the last 19 years, and because of that, and the volatility that we've had since 2000, your 4% rule, remember, take out 4% a year, increase inflation, it didn't work. You're almost broke.
That's scary.
That's if you were 100% stocks, nothing else, which nobody's 100% stocks through their entire retirement, typically, right? So in other words, you went broke probably 14, 15 years into retirement. That 4% rule was supposed to last 30 years. 90% chance of lasting 30 years, and it didn't last half that much.
That's right.
So what significance is that? Well, the significance of that is, let's say you've been saving money for retirement for the last 30 years. You got a couple $1,000,000 bucks, and you were figuring, well, I can take 4% out, 80,000 plus my Social Security. I can live on that. It doesn't work anymore. You have to look at alternatives. We have some great alternatives to show you to get you more than the 4%. You can get 6 to 10% and get it guaranteed for life. It allows you to not put as much towards your income bucket, whatever. But you got to look at alternatives, because the rules that we've had for all these years, decades, do not work when you have a market making under 5 and volatile as crap. 972-715-2424. Remember, take advantage of any of our services. We can answer any question you've got. I'm getting crazy. It's Christmas next week.
Have a wonderful holiday with your family.
Have everybody Merry Christmas. I'm Victor McClure for Guy Allert. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment, product, or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.